G'day team, just back from work and here with Loopy, of course, co-host for today. And as per the title of today's video, we've sat down and read the RBA meeting minutes, basically so you don't have to. Not one of the great pieces of literature of our time, certainly no Treasure Island, but look, if you're interested in property, economics, skin in the game, which basically all of us do, even if you've got superannuation, certainly worth paying attention to or having a read if you've got the time. I'll put the full link to that in the description of today's video, but otherwise, over the next couple of minutes, I'll rip through the highlights for you. So, first thing, of course, they talked about was international economic developments. In short, global inflation remains high, but possibly may have peaked. Goods inflation is slow due to eased supply chain and upstream cost pressures. Services inflation remains high as well. I think one of the big things internationally is, certainly in relation to us here in Australia, is the COVID-19 containment policies have lifted in China, which means their economy might start bubbling along, certainly over the next couple of months. So that was something worth keeping an eye on and making mention of. But all in all, really, it's not great. Global outlook is pretty uncertain at the moment. Okay, a lot of fear, uncertainty and doubt. And I think a lot of this probably is also linked to what's happening politically. The business obviously over in Ukraine and things like that. So, but yeah, inflation around the world continues to skyrocket. Measures are being put in place to contain that, not just here in Australia, but also internationally. What's happening closer to home? Well, domestic inflation was high. We know this. Talked about that in my last video. Again, a link will be made available to that at the end of this video. So if you want to do a bit of a deep dive into perhaps some of the drivers behind the inflation that we've got here in Australia, that's certainly available for you. Inflation in services continue to go up. Wage growth has continued to pick up, and unemployment continues to remain relatively low. And this is, I think, one of the big issues that we're sort of seeing at the moment as well. I mean, normally as you begin to pump up interest rates, which has been happening over the last couple of months, the economy slows down. And one of the big things linked to that, of course, is an increase in unemployment. It is hitting the tech sector hard though. We've seen layoffs across a lot of startups, also consultancy and things like that as well. So I think that'll start to play out over the next couple of months, and again, something else to keep an eye on. The other thing, which is probably a bit of a driver which has been rolled into domestic economic developments that I discussed, is the spending from the government to really kind of keep the economy ticking over. And it was actually a piece released by consultant Deloitte, and they were talking about how if you're trying to curb inflation, certainly increasing interest rates is one thing, but if you continue to stimulate the economy with government projects and government spending, you're kind of offsetting some of the good that perhaps you're doing by increasing inflation rates. How did it impact the financial markets? So central banks in a number of the advanced economies have slowed their pace of policy rate increases. So again, not being quite as aggressive with the interest rate increases that they have been. Market expectations for policy rates, so what people think is going to happen in the future, have begun to peter off as well. So there's an expectation that the ongoing increases and perhaps the degree to how aggressive they're going to be is beginning to drop off. So perhaps a little bit of confidence coming in. Longer term government bond yields have declined in most major advanced economies since the beginning of 2023. Locally, with domestic financial markets, housing credit has slowed. We've seen that. New loan commitments have declined. The funding costs associated with loans have obviously increased. Households required mortgage repayments are increasing. And of course, the cost of living is increasing as well. So that's causing a real pinch. We also talked about in my last video the savings that households had accumulated over the preceding couple of years. Still looking to see how that's playing out and how that large volume of money, I think we quoted 250 billion, is getting pumped back into the economy. So that's something to keep an eye on. And there was an expectation really, which of course was realised, that there'd be a 25-point increase in the cash rate, which is exactly what happened. So what are the key things that they considered with respect to monetary policy for this month and moving forward? Inflation in Australia remains high. Okay, so it's not really coming down as much as they'd hoped. Domestic demand is strong, but the economy is struggling to meet that. The Australian economy continued to grow strongly despite the measures that we've put in place to slow it down, but there is an expectation that this slowdown is going to happen over the next couple of months. You made mention, of course, of unemployment, so it's the lowest level it's really been in 50 years, and that's not kind of changing at the moment. But again, as I said, I think that'll change certainly over the next couple of months. And the 25 basis point increase was rolled out. So that was really the long and the short of it. I hope you enjoyed that quick and brief summary. As I said, link to the full minutes will be made available in the description. And if you'd like to do a bit more of a deep dive into the inflation and perhaps some of the causes behind what we're seeing here in Australia and the subsequent interest rate increases, there's a link to my last video up above.